Cyprus has become even more attractive for those fleeing European tax prisons in 2026. The new Cyprus tax reform is fairer and easier to understand. It's meant to stimulate economic growth rather than increase revenue for the state. It offers unique opportunities for residents and foreigners you won't see anywhere else in Europe, making Cyprus even more tax and business friendly. Today, I'll cut through the noise and focus on 10 most important changes for individuals and businesses. Number 1. Personal income bracket has been adjusted. Under the new reform, you can now earn up to 22,000 euros completely tax-free, compared to the previous limit of 19,500. So if you want to be on universal healthcare while living off of Dividend as a non-dom, you will need to pay yourself some salary to get access to it. Now you can pay yourself an extra 2,500 without having to pay a single euro in income tax. Number 2. Dividend taxation has also received a complete overhaul. Up until now, local Cypriot entrepreneurs and investors were severely disadvantaged, being unfairly charged a 17% tax on their dividend income, while foreigners with a non-dom status were exempt from this tax for a period of 17 years. From the start of the year, the 17% tax has been reduced to 5% for tax residents who are domiciled. This actually makes Cyprus an even better long-term option. When your 17-year non-dom exemption runs out, you won't get hit by a massive 17% tax bill. You just move up to 5%. Next up, we have to talk about tax on cryptocurrencies. Up until now, Cyprus has been pretty vague on this law. Two people doing the exact same trade could end up with completely different tax bills. But now Cyprus has a flat 8% tax on all crypto-related profits. This tax applies to everyone. Individuals pay 8% instead of their high personal income tax, and companies trading crypto also pay 8% instead of corporate income tax. The standard corporate tax rate is moving from 12.5% to 15%. Although nobody likes a tax hike, I see it as a strategic move. The government raised the corporate tax to stay compliant with international regulators like EU and OECD, which keeps the island from getting blacklisted by EU. Cyprus retains its appealing status as a low-tax jurisdiction without the scrutiny and banking issues that comes with the several other low-tax countries. Less headaches for everyone. Number 5. To compensate for the corporate tax hike, Cyprus scrapped the deemed dividend distribution rule and finally adopted the Estonian model. Until now, you were basically forced to pay out 70% of your profits as dividends every 2 years, whether you wanted to or not, which could drain your company's cash reserves just to satisfy the tax office. Now you can reinvest your profit back into growth, and the government stays out of it until you decide to pay yourself dividends. Number 6. And speaking of reinvesting for growth, the best investment you can make is usually in your team. In the past, giving equity to an employee was unappealing. It often meant hitting them with a 35% income tax bill. Now, Cyprus has a flat 8% tax on approved stock options. But the new stock option scheme comes with strings attached. There's a 3-year vesting period and a 1 million euro lifetime cap for over 10 years. Even with these rules, stock options tax puts Cyprus on the map for attracting global talent. The 7th tax reform we have to talk about is the R&D super deduction. This deduction has now been extended to 2030, and if you're a tech founder, you really need to know about this. For every 100,000 euros you spend on eligible R&D, the government allows you to deduct 120,000 euros from your company's taxable income. Yes, you get to deduct more than you spend. This is a massive incentive that not only lowers your corporate tax bill, but effectively uses the government of Cyprus to subsidize your growth. The next tax reform is not a big change, but rather a nice adjustment that gives companies extra breathing room. In the past, your company's losses could only be carried forward for 5 years before they expired. This limit has now been extended to 7. But the ninth tax reform is a big win for deal-making, the end of stamp duty. From the start of 2026, stamp duty on contracts has been officially abolished. Whether you're raising VC money or restructuring a holding company, you used to get hit with this tax on every single legal document. It wasn't big money, but rather an administrative annoyance that slowed everything down. From now on, this friction is completely gone. And finally, I saved the most fun change for last. The government has nearly doubled the tax deduction limit for entertainment expenses. Previously, this was capped at around 17,000 euros, but starting now, that limit has been raised to 30,000 euros per year. This acknowledges the reality of doing business. Closing deals often happens over dinner or drinks, and now you have nearly double the room to deduct those costs against your taxes. Before we wrap up, there's one more thing worth mentioning. While the new tax reform has introduced a lot of changes, the foundations that make Cyprus so attractive are staying exactly the same. The non-dom regime remains, including the 0% tax on dividends and the 60-day residency rule. The same goes for the IP box and its 80% tax deduction. On top of that, we still have 0% withholding tax on outgoing dividends and 0% capital gains tax on shares. If you found this breakdown helpful, please hit that like button and subscribe. Thank you for watching, and I'll see you in the next one.